welcome back to The Explainer. Today, we're diving into the absolute realities of the market as of June 22nd, 2026. We're looking right past those flashing daily headlines and ticker symbols to uncover the massive, deep structural forces that are literally squeezing the global economy right now. It's a fascinating environment, right? One defined by intense, heavy pressure at the top and a really widening fracture at the very bottom. Over the next few minutes, we're going to visually break down exactly what's happening, why it matters, and how it directly impacts everything from corporate boardrooms all the way down to your summer travel plans. So let's get into it.
Here's our top-down roadmap for today. We'll kick things off with the liquidity squeeze, then move into global trade and geopolitics, hit the AI hardware crunch, explore consumer bifurcation, and finally, wrap things up with the catalyst calendar.
All right, Section 1, the liquidity squeeze.
We are witnessing a monumental shift right now. Systemic liquidity evaporation, not your traditional interest rate hikes, has suddenly, almost out of nowhere, emerged as the absolute primary risk to equities. Just look at the sheer scale of this number. The Warsh Fed has enacted this dramatic policy pivot, stepping away from just tweaking interest rates to actively, aggressively tightening liquidity to fortify their credibility because, let's face it, they've missed that 2% inflation target for the last 5 years. They have absolutely slashed reserve management programs. We're talking from $40 billion down to just $10 billion a month. Wow. On top of that, Treasury buybacks have been cut by roughly 50%. This is a massive, coordinated drain of capital from the financial system, and it's happening right as lending growth accelerates. So what does this actually mean? Well, we're heading straight into a really dangerous intersection known as the Warsh test. Picture this. On one side, liquidity is tightening rapidly as the Fed drains capital out of the system. On the other side, earnings revisions are starting to slow down. That collision point right in the middle, that's the exact moment liquidity dries up just as companies are really struggling to maintain their growth expectations. As Morgan Stanley recently pointed out, equities are staring down an imminent stress test. The Fed has basically committed to accepting some serious short-term pain to reach their longer-term goals, and this perfectly visualizes exactly where that pain is going to start. To really grasp the severe downstream risks of this macro liquidity drain, we need to look at what's called a corporate variable rate perpetual debt doom loop. Sounds intense, right? Well, it is. It starts off with targeting a $100 par value just to fund this frenetic Bitcoin buying spree, issuing over $10 billion in under a year. But wait, as liquidity tightens up, the company gets hit with yield escalation. Basically, to attract buyers, they have to hike the coupon 7 times to 11.5%, which pushes the effective yield all the way to junk levels of 14%. This triggers a total funding trap. The business is producing almost zero cash flow, so they actually have to pay dividends using capital from new investors. Ultimately, just to service this massive debt, the company faces 2 brutal options: massive dilution of common stock or a forced liquidation of their Bitcoin holdings. It's a textbook perfect storm showing what bankruptcy and dilution realities look like when the liquidity tap gets shut off. Okay, let's shift gears to Section 2, global trade and geopolitics. Stepping away from domestic Fed policy for a second, friction abroad is adding a completely different, incredibly heavy layer of pressure to the global macro picture. And honestly, nowhere is this tension more visible than right in the Strait of Hormuz. We've got these incredibly shaky US-Iran peace talks happening in Switzerland, with negotiations really hinging on some very complex military dynamics over in Lebanon. Yet, and this is fascinating, check out the operational resilience here. 67 ships successfully navigated the strait on Saturday. So commerce is finding a way through. But there is a massive catch. This geopolitical risk carries a steep premium. Brent crude is up 30% year-to-date. So even though those ships are still moving, this sustained diplomatic friction is placing a firm, undeniable floor under global energy costs, which, you guessed it, feeds right back into the inflation narrative we were just talking about. Moving on to Section 3, the AI hardware crunch. Now, the really crucial point here is how this broader macro squeeze is on a direct collision course with massive technological shifts. All this artificial intelligence exuberance we've seen lately, it's placing unprecedented, mind-boggling demands on infrastructure, and it's forcing a desperate race for efficiency. Think about the legacy model championed by giants like IBM. Massive fleets of quantum computers access mostly via cloud infrastructure. But as AI data centers start drawing insane amounts of power, the whole game is shifting. Compare that to European leader IQM, who are actually making history as the first European quantum company to trade on NASDAQ. They're pivoting hard to on-premises system sales, and they've already sold 23 gate-based machines. Their big differentiator?
They pair superconducting quantum tech with classical processors to drastically cut down power consumption and accelerate solution times right there inside the data center. It's a total game changer.
And here's why that tech shift matters to all of us. It builds into a direct inflation threat across the entire value chain. Way upstream, this insatiable AI demand is driving a severe memory chip shortage. I mean, Micron is anticipating an 800% revenue surge over the past 12 months. That is just astronomical. But then downstream, highly capitalized giants like Apple are getting totally squeezed by these soaring memory costs. Their solution? They're forced to raise prices on smartphones and PCs just to protect their hardware margins, which leads us to the ultimate macro impact. What is incredibly bullish for a chipmaker like Micron actually translates all that AI exuberance directly into consumer inflation, putting the core PCE durable goods metric at serious risk.
Which brings us perfectly to Section 4, Consumer Bifurcation.
Let's zoom all the way down to the ground level now. This top-down economic squeeze we've been tracking, it's literally fracturing the American consumer base right down the middle. Nowhere is this more obvious than in the housing market, which is finally exiting its deep freeze, but with a severely asymmetrical recovery. Look at the Northeast. Inventory is super constrained, pricing growth is accelerating, and contract signings are rising sharply after months of stagnation. It's incredibly hot. The South? Well, it's normalizing and stable. But look out west, specifically Phoenix. The market out there is completely stale. It's the spring housing season that just didn't happen. Pricing is under heavy pressure, and it's easily the most challenged region. Single-family homes are languishing on the market for an average of 73 days, seeing only a microscopic 1.2% year-over-year uptick in contract signings. It is quite literally a completely divided reality, depending entirely on your zip code.
And you know what? We're seeing this exact same divide in everyday consumer behavior, too. Unprecedented premium spending is crashing right into ground-level frugality. Take the entertainment sector. Premium event spending is absolutely shattering records. Disney and Pixar's Toy Story 5 just broke the year's box office debut record with a staggering $230 million opening weekend. But here's the real metric. An astonishing 97% of those 11.2 million viewers opted to pay extra for premium and IMAX formats. Consumers are definitely splurging on the high end, but flip the coin and contrast that with budget optimization in travel. Amid all the recent air travel turmoil and rising gas prices, budget ground transport, think Flixbus and Greyhound, saw a massive 30% surge in passengers on routes that overlapped with defunct budget airlines. It really looks like the middle class is hollowing out. Right now, you're either paying up for IMAX or you're taking the bus to save a few bucks. All right, let's wrap this up with Section 5, the Catalyst Calendar. These are the absolutely key data drops coming up this week that will severely test this entire macro to micro narrative we've just mapped out. Here is the exact timeline you need to track. Ongoing right now is the U.S.-Iran diplomacy. We're keeping a close eye on finalized mechanisms terminating military operations in Lebanon, which is crucial to secure the Strait of Hormuz. And remember, that dictates the price floor for Brent crude. Moving to Tuesday, we get our macro bellwethers with FedEx and Carnival earnings. These are going to provide a crucial read on global shipping volume and give us a real-time proxy for consumer travel spending. Then Wednesday is the big AI health check when Micron reports aftermarket. That is going to severely test the sustainability of those 800% hardware gains we talked about. And finally, the whole week culminates on Thursday with the big inflation reality check, the May PCE report. Which leaves us with the ultimate question as we wrap up this explainer. With core PCE expected to rise at a 0.4% monthly rate, all eyes are going to be on that critical durable goods component. Will Thursday's report reveal that those skyrocketing AI hardware costs, the chips literally powering our future, are finally passing through and fueling inflation for everyday consumers buying laptops and smartphones? It's really the ultimate test of whether the tech boom is about to bite the very consumers driving the economy. Thank you so much for joining me for this deep dive. Make sure you keep your eyes on the data this week, and as always, keep questioning the headlines. I'll see you next time.